Okay, welcome back to another video. So gold's rally isn't just a price story, it's becoming an infrastructure story. As prices push into record territory, we're now seeing second order effects in the physical market. Specifically, vault operators are hitting insurance caps because the underlying bullion value has risen so sharply. This isn't just operational noise, it signals that the gold market is moving from simple macro positioning into structural stress territory. Zooming out, the rally has been driven by the usual macro cocktail: geopolitical risk, central bank buying, concerns over fiscal sustainability, and sticky inflation narratives. But the key here is persistence. This isn't a short squeeze or temporary spike. Prices have remained elevated long enough that operational systems designed for lower price regimes are being challenged. When physical infrastructure starts adjusting, that tells you that this isn't just sentiment, it's structural repricing. So here's where it gets interesting. Vault operators typically insure holdings up to fixed policy limits. Those limits were set when gold traded materially lower. Now at higher valuations, the same quantity of gold breaches those caps, so operators are either reducing insured inventory, paying materially higher premiums, or carrying partial exposure uninsured. From a risk perspective, that introduces new fragility. Insurance is what makes physical gold institutionally viable. If coverage tightens or becomes more expensive, the cost of holding physical metal rises, and rising carry costs matter. Gold is widely used as collateral in secured financing, but collateral quality depends on clarity and coverage. Fully insured bullion is clean collateral. Uninsured or partially insured metal, that likely gets a haircut. That means higher funding costs, tighter lending terms, potentially liquidity friction in the bullion market. So while the rally looks bullish on the surface, underneath we may be seeing increasing friction in the system, and friction eventually feeds back into price. So finally, onto strategic market signals. This is where traders really should pay attention. When infrastructure begins adjusting, that can create nonlinear effects. Insurance constraints can act almost like a soft ceiling, not because demand disappears, but because the cost of participation rises. Markets don't move in straight lines. If operational stress builds, volatility may increase. So in short, gold's rally has moved beyond macro narrative. We're now seeing signs of system stress, and that's usually where market structures become just as important as fundamentals.